Hey everyone, Jonathan Gorenstein here, the Industrial Insider. I have a really special guest on the docket this week, a veteran in the industry, Mr. Michael Bonneville from Skyline. I'll let Mike do his own intro, tell us a little bit about yourself, tell us a little bit about Skyline and what you guys are up to. Maybe we can even talk about how Skyline is structured, because there's obviously many different arms of Skyline, and I'm sure it's confusing for a lot of people, and especially the broker community. And we'll go from there. Mike, why don't you tell us a little bit about yourself?
Sure, John. Thanks again for having me on this. It's fun to watch the podcast. So, nice to be on the other side.
Thank you.
I've been with Skyline for almost 12 years now. I run the acquisitions for the Skyline group of companies.
Yep.
And just as a bit of 5-second overview on what we are. So Skyline runs 3 separate real estate investment trusts. We have the Industrial Trust, which is a little over $1 billion in assets, and runs from Quebec to Alberta. We have the Retail Trust, which is about $1.2 billion. Similarly, Quebec out to BC, and then we have the Multifamily Trust, which was the initial fund that was started up by the partners, and we are coast to coast, Halifax out to Vancouver Island. So in total, between the 3 trusts, we're about $5.5 billion in AUM, and then we've recently started up a clean energy fund, which is primarily focused on solar fields and starting to get into other green energy sources.
So do you take care of acquisitions for all 3 buckets, or are you just focused on industrial?
I oversee them all, but primary focus on the industrial and the retail side. The multifamily is covered by another gentleman in my office.
Got it. So I guess let's get into what assets you guys are looking at currently, where you see value, what type of assets you like to see in the marketplace that you say, oh, you know what, that's something that we need to bid on. So the broker community or even other people in the market really understand what type of assets really fit in the Skyline profile.
Sure. And so, as I said, we're on the industrial side. We're a REIT, no different than any of the public guys. Our main difference is all our capital's privately raised through our exempt market dealers. So, we're a dividend paying entity. So we're really focused on good, strong cash flowing assets. The company being based out of Guelph generally has been for the multifamily side and the retail side, a little, I would say, secondary, tertiary market focused in terms of acquisitions. The industrial fund is different from that. So we have large holdings in Ottawa, Montreal, Calgary. We have some assets in the GTA, and then another kind of segment of the portfolio along the 401 corridor in Ontario. But really, we're looking at, and it's changed a bit over the last couple of years, where we're more focused on, call it, larger tenancies, more logistical e-commerce, much like lots of other investors right now. Although we do a bunch of small bay assets, we have a large holding of that in Ottawa. But I would say the bulk of what we're looking at currently would be, larger, either single or multi-tenant assets, less than 10 years old. But given, as you and I have chatted about, the, call it, difficulty in terms of trying to price that kind of asset within the GTA and even within an expanded GTA, I would say we're finding more opportunities kind of in our backyard. So at the Brantford, Cambridge, Kitchener area. And then also, over the last 12 to 18 months, we've been looking at opportunities out in Alberta. We bought a large portfolio in Calgary in and around the airport last year. We're actively looking at other opportunities in Alberta that kind of fit that mold.
Okay. At the beginning of your answer, you mentioned how you're structured as a REIT. How are your deals funded? Like, where does the money actually come from? Like, how do you really set up the profile that of the assets you're going to go through? Do you essentially sit around in a boardroom, say this bucket of money has to go here, multifamily, and then this bucket of money has to go to tertiary markets for industrial? Like how do you guys structure where the money goes, how the money comes in, and where you guys distribute your funds?
Sure, good question. Our exempt market dealer that raises all the capital, it gets raised for specific REITs. So say the industrial fund is looking at an acquisition and has tied it up. We have an operating line of 30 or 40 million bucks. So it's easier for us to, kind of tie up an asset, fund it, and then backwards capital raise after that. Really it's each one of our REITs is run separately. It has a separate president, it has a separate board of directors, and it engages our wealth manager to go and raise X amount of capital for deals it's committed to. That pool of investors, which is virtually 100% all retail high net worth individuals, is about 4,000 across the country. Small proportion would be overseas, but really the lion's share is Canadian domestic. And a good example is we were out for a raise on our clean energy fund last month. I think they were out to raise $25 million for a number of acquisitions. That was done in about 8 days. They opened, closed it. It's a fairly well-oiled machine. I would say ex-COVID, so ex-2020, which obviously there was a gate, no one was doing anything for a long period of time. But 2019, across all the funds, I think we raised somewhere between 150 and 200 million in equity. And generally that's done, within 20 days, 25 days, depending on the size.
So essentially you guys did have it down to an art.
Yeah, it wasn't always this way. Obviously when we first started out, it's, and you're a much smaller entity, raising $5 million in a month was, a big feat. And there, was a lot of high fives around the room. But just given, how like Skyline's been, a going concern, at least from the multifamily standpoint now for over 20 years. It's a very large network, and I get lots of calls of guys that are trying to emulate that private, REIT structure, right? Where they're like, well, how do you raise the capital? And it's years and years and years of hard slogging, calling people one at a time. Luckily, that wasn't me. It was, a couple of the founders who were, doing webinars, in their RV while their family slept at night because their two people out in Vancouver wanted to talk about it, right? So
a lot of Zoom calls back in the day.
Exactly. Yeah, Zoom calls before there were Zoom calls, right? So
okay, let's why don't we move on to the market. I'm sure you're exposed to a lot of deals that come across your desk on the acquisition side. I guess what is the most surprising thing that you've seen over the last 6 to 12 months? And then a second part of that question is, what's your prediction going forward? Acquisitions, dispositions, or anything in regards to the market?
I would say, kind of the biggest surprise in the last 6 months, isn't the demand that we're seeing in certain sectors like industrial. Yeah. I think everybody kind of saw that coming with what was going on and the trends, conversion trends in retail, vacancy rates as they, and they were falling 24 months ago, right? Not just in the last 6, but right. I think it's the sudden spike, in underlying rents on the industrial side. And that's, it feels like it's deal to deal, right? The last guy, got $12. So, okay, I'm the next newest thing and no one has anything else available. So I'm $13.50. Right. There's been sticker shock from our part, right? As you try and, as I said, we're not a super active acquirer in the GTA. So you're kind of, it's kind of trying to follow where that trend is from a leasing standpoint. Where we have been, I would say, very active is in the Montreal market. We've recently completed a partnership with Rosefellow. That's a new development company that was put together about a year and a bit ago. And we've collectively acquired 5 sites with through that development entity, and 2 really, really good guys that are running that. But where we started out and you're pro-forming, $950 rents, and you're all looking at like, this is Montreal, right? Where rents haven't moved off $650 in 25 years.
Right.
And all of a sudden they're like, wow, we just heard there's a deal down the street at $1050. And I think maybe, this group's going in and they're now talking $1150. So it's this, I think it's the national level at which rents for the next best in class are exponentially going up. I think that's what's surprising me more than anything.
So given that, where do you think the market's going? Do you think it can sustain this upward trend of lease rates, compression of cap rates? Just like as before this call, we were talking about buildings possibly trading in the 300s. Like if you talk to anyone 24 or 36 months ago telling them that an asset would trade for in the 300s, they would have told you were crazy. But right now it doesn't seem that unreasonable these days.
Well, I think, if land's now trading, in the GTA at what, 250 or 2.5, 3 something an acre, depending on where you are. Right. And then DCs being where they are in different locations and probably not going backwards. And, if anyone's doing a basement reno in their house, or, a contractor I was dealing with yesterday told me that the price of a 2x4 has gone up 5-fold in 7 months.
Right.
So, you look at all those things and all of a sudden, and again, with the stuff that we're doing in Montreal, I know, and land's still a lot cheaper there than it is in the GTA, is you can barely build it for getting close to 200 a foot.
Right.
So if in the GTA, if the land is double the price and DC's
right.
on top of that, and then just market demand, like can the next guy in build, if he's got to buy the land and do all those things, is he 250, 275 just to build it?
Right.
So, I think I think inflation and demand and just the cost to get in the game may keep us here for a while.
Okay, so with that, where are you? Given you're talking about all peripheral markets. Let's take Ontario. So maybe Waterloo, Windsor, any of the markets outside of the core markets in the GTA. Where do you see the most opportunities? I know you mentioned the 401 corridor, but is there a particular market that you feel that is maybe undervalued? Or I don't know if you don't want to give away your secrets. But is there anything that you could share that you think would be a good opportunity for the industrial market?
12 months ago, I think there was actually, some things that people weren't paying attention to. There's a trade that I don't think is firm yet, but is getting close in Brantford, Ontario, which I think up till 12 months ago, we were the only group, call it from a institutional size that were really spending much time there. And the deal is going to go in the mid 4s, right? And the last deal I bought there was mid 5s.
Right.
So, but it's scale, it's new, it's scale, it's very good quality. But it's a market that's, is where a lot of places were before, just very slow rent growth, not, it's more an owner user market than it is a third party investor, management market. But I think, as we talked about, right, if Milton is going to, be a $12 rent and, a company is going to say, well, I can afford, I can do the math and build in that I can go 20 minutes down the road and I'm okay going to Brantford and I can save $6 to $8 a foot. I need to think about it. So I think that's, you look at Cambridge and you look and Hoop's investment there, Bentall's investment there. There's a lot of the life cos and fund managers have been there for a long time. they're really starting to see the growth in rents there. So
Yeah.
I'm not sure there's a good secret anymore. So
Tony's huge development in Hamilton. So
yep.
a lot of groups that are looking west and east of the core for sure.
Yeah, and I've heard, those ones down there, even though there's, Amazon's going in there, and then a bunch of groups have bought, as you said, Panettone's bought land down there. And what my understanding is rent, for new build is $950, right? Like, so it's not like you're going from Milton again from whatever, $10-11, and you're dropping down, right? It's okay. Maybe the taxes are different and maybe there's a little more employment, but
no development charges, but construction costs are all the same.
Yeah. Yeah. Same, because same builders are going to go one place or the other, right? So it's not that far away.
Exactly. All right. Well, Mike, I want to say thank you for joining me on the podcast. I appreciate your insight and taking the time to join with me. I look forward to doing some business with you in the future, and I appreciate you coming on.
Yeah, no worries, John. Appreciate it. Sorry for the technical difficulties at the start. It's, like I said, my entire IT team's working from home, so hard to do any fixing. So, but thanks for the time.
I appreciate it. Have a great day.
All right, you too, man.